Victoria, this beige book sounds really pretty beige.
It does, Tyler. And, we kind of anticipated that we would hear the same thing that we heard from the last beige book, right? Slowing global growth, trade and tariffs continuing to be the same issue. We heard that after the last FOMC meeting. We expect that we would hear it from this. The only difference really that we were looking for was in the housing sector. In the last beige book, they talked about having constrained housing sales, and we've really seen that pick up. I haven't read the details yet of the report, so I'm not sure how they're categorizing housing at this point in time, but we actually see that as an area with a lot of upside potential going forward, and we've seen that, especially with the NAHB report coming out this morning. So that's an area where I would look more into.
Steve, as an economist, where overall do you see U.S. growth trending for this year? Is it a 2% year, even though the first quarter was higher than 3%, which would suggest then that maybe this fourth quarter is going to be well below 2%? Where do you see that sweet spot number?
Yeah, I think that's a good question. I think the reality is it's going to be somewhere between 2 and 2.25%. So, yeah, there'll be a little bit of a deceleration as the year goes on. You'll see a little bit of that evident as we go through the entire third quarter numbers and get those out in more detail. And then we'll see a little bit more in the fourth quarter. But I think the fourth quarter will end on a stronger note heading into 2020.
Victoria, let's talk a little bit about corporate profits and what we're seeing so far. They seem to be beating estimates, at least what we've seen, or mildly beating estimates. What are you looking forward to in this corporate reporting season, profit reporting season, and what do you see for 2020?
Expectations right now, Tyler, are expecting a double-digit year-over-year growth in 2020. And we just had our investment policy committee, and we were really debating this and what our outlook was. We expect to see things continue to trend higher, but we're not so sure that we're going to see that double-digit growth in 2020. We are so far, just with a couple days of really heavy-hitting earnings coming in with the financials, we are doing better than expected. And so we can see sentiment start to change a little bit. That really can drive the economy. That drives people's spending habits. So we can see companies start to generate better numbers and see expectations maybe go up a little bit. But I still think a 10 or 11% growth rate for 2020 might be a little bit high.
Quickly, before the others jump in here, why do you expect corporate, even though you don't say this is going to be double digit, why do you expect them to be that good if the economy is way slower than that? What is it comps are going to be better or what?
Well, I'm not sure that it's just coming down to comps, but we have to look back at where we sit in the economy. Yes, we see things slowing, but look, the consumer is really strong, and we're starting to see troughs in a lot of areas. Emerging markets seem to be having a little bit of a trough at this point and starting to come out of that, at least in the majority of those areas. If we start to see global growth turn around with a trade, we don't have a big deal, but a small deal in trade, we'll start to see some more positive numbers come out and start to see things turn around in the Eurozone, then I think we'll see expectations move higher, and not just the consumer, but the overall economy will start to be better.
Steve, how do you feel about the consumer at this point with disappointing retail sales numbers? And then within the beige book, we have household spending remains solid. And we've also heard from a lot of the major banks, JP Morgan, Bank of America, saying the consumer has been strong. Where do you fall? Are there shadows of doubt on the consumer at this point in your view?
No, I don't think there's any shadows of doubts on the consumer. I think the consumer is responding to 3% year-over-year wage growth. And with a lot of consumers living paycheck to paycheck, which is not necessarily an ideal situation, 3% wage growth gives you 1.75% consumer contribution to GDP. You get a little extra adjustment from inventory, government, or trade. And next thing you know, you're running at 2.25%, which is where we expect it to run. The important thing, though, the more important thing I think that's going on that'll affect earnings is the downward pressure we're experiencing on inflation. And I think that's going to continue to be an issue going forward. And I think that reduces nominal GDP growth as we go into 2020, into the end of this year. And I think those are the factors that will wind up causing people to downgrade earnings expectations and make the double-digit numbers that Victoria was talking about less and less realistic as we go forward in here. Because it's going to be harder and harder with less and less pricing power to drive those kind of earnings.
Interesting.